All right, good morning. Can you hear me? Am I too loud, too quiet? Just right. Let me know in the chat room. Let me know if you can hear me. We are on a bit of a time delay, streaming from Bali. Let me know in the chat room if you can hear me and if I need to adjust the audio level. All right, we'll get going here in just a minute. I want to make sure I don't start before 8:30 in case anyone joins and misses it. We had 6 viewers, but now we're down to about 3, which is just fine. Would be nice if we got a lot more viewers. It's a lot more fun if we had 20 people. So be sure to share this with your friends and family, anyone you think that might benefit from learning about investing, especially the wheel strategy, which is really great. Now we're down to just 2 viewers. I guess it's just Rashid and Wayne. No one else wants to learn about the wheel strategy today. Happy to take on questions today. Had a weekend. Went out and found some good picks already. Might not be sharing those with you because we'll get into that later. But I'm happy to have you guys here. And if anyone has any stock picks today that want to discuss their picks, their ideas, happy to do that. And we can, of course, do a quick fundamental analysis on that as well. And I've got all new slides today, so that's the great fun thing about today. We've got new slides. So it's 8:30. Let's go ahead and get started. And only 3 viewers today. Make sure you share this. We'll make it more fun when it's live. I guess everyone else is still sleeping 8:30 in the morning, and they'll watch the replay later. So for those of you who are new, this is the wheel strategy explanation segment of our show. First, we start by writing a cash-covered put. If that gets assigned to us, we write a stock-covered call using the stocks that got assigned to us from the cash-covered put. But if you do this correctly, you usually don't go past steps 1 and 2. You write the cash-covered put, it doesn't get assigned, you collect your profit, you write a cash-covered put, it doesn't get assigned, collect your profit, and you repeat for many months. All right. Let's get started with the new slides. So the wheel is a management strategy. It is a management strategy. It's a tool. It doesn't work on trash companies. It's like a hammer, but not everything is a nail, so we don't go around looking for the wrong companies. You have to find the correct setup and the correct company. The wheel is a strategy. It is not a spread. It is not a one and done. You don't just put on the spread and then wait and then get cash in or cash out. It is a multiple layers of things that you can do in order to maximize your profit or to recover from a loss. It's important to understand the wheel is a strategy, not just a spread. It must be followed to be successful. If you have a strategy and you miss or skip an important step, that strategy goes down the drain. Kind of like if your running back is supposed to run 10 feet forward, then cut to the right, look to catch the ball, then cut left. If they only keep going forward 20 yards and never bother to cut right and look for the ball, that strategy just went out the window. Okay? Strategies fail when you break the rules or skip steps. So, how to fail with the wheel. Now, I'm going to pick on these guys just a little bit. I think they're actually okay. And they might be open-minded to discussing the wheel some more. But these guys were ragging on the wheel the other day on their live channel. They talked about it destroying multiple accounts. And they're going to tell us why, and then it just sort of trailed off, and then they went into their normal spiel of their strategies. But here's how the wheel fails, because it can fail. Number 1, if you're lazy and you skip the fundamental research, the wheel has a higher chance of failing. Number 2, if you're greedy and you prioritize good setups over good companies. So this is almost the opposite of day trading. Day trading, you can look at the technical analysis, you can find a good setup, you get in, it doesn't work, you cut your losses, you move on. You're just intraday trading. With us, with the wheel, you need to have a good setup and the good companies, okay? Number 3, fear. You panic and you manage too soon, meaning you sell or close the option when maybe you should just let it play out. Number 4 is greed. You do not position size correctly. You position size too large for the account. And number 5 is you're, again, lazy and you're taking on too much sector risk. So, that out of the way, how to succeed with the wheel. Number 1, be patient. Be patient. Be patient. Be patient in finding your companies and finding your setups. Do the fundamental research. Number 2 is balance. You have to have a good setup on a good company. You need both to be there in order for the wheel to work properly. If you find a good setup, you find a company, you find an option that's going to pay you 8% a month, that doesn't mean it's the right candidate for the wheel, right? You might have a bad company, and then you'll get stuck with it. So if you go out and you find a good company, you might only make 1% a month on the wheel, or 0.5%. Well, now you don't have a good setup. So you need both. You need to have a good setup and a good company. Number 3, you need the trust in the system. You need the trust in the strategy. You need to manage properly. Don't close too early. Number 4, discipline. Position size to fit your account. Your position size needs to fit your account. If you have a $10,000 account, maybe you shouldn't run out and do a $60 stock because you're going to have to buy 100 shares. You're going to tie up $6,000 of your $10,000 account. Okay? Maybe you should size down a little bit and go look for some $5, $10, and $20 positions to put on. Okay. Also means if you find a good, let's say you can find a good, 5, 6, 7, 8% return. Well, does that mean you open up 20 contracts? Well, depends on your account size. You need to fit the position size to your account size. If you don't do that, you could mentally mess up on the wheel because something's going to eventually get assigned to you. Well, you don't want it to take up too much of your account. And number 5, balance. You need to select companies in different sectors. This is the one that I've actually been ignoring for about a year. It has not come back to bite me yet, but I'm starting to see that this is the weakness in my current trading strategy that I haven't been doing, is I need to be across different sectors. When Tesla fell, right? That had a big negative impact on my accounts, not actually my wheel account, but on my other accounts, and I realized, you know what? I have a lot riding in one sector. Same thing with Bitcoin. I have a lot of Bitcoin shares and a lot of Bitcoin options that were operating simultaneously. If Bitcoin were to suddenly drop 50%, it recently dropped 15%, but if it dropped 50%, that would be a major hit on both my wheel strategy and my other strategies, okay? So you want to start thinking about going across the different sectors, which is what I've been doing, and I'm willing to lower my expectation. In other words, I'm giving up on the 5% a month, going down to about 4% a month as my target goal in order to get me to the sectors that I want to be in. So, one of the reasons why we use the wheel strategy is that it's not day trading, because day trading takes all day. You should be glued to your computer pre-market, during the market, and after the market. When you're day trading, you're making money while you work. So it is, in fact, a day job. Now, how many of you guys, let me know in the comments, have already read Rich Dad's Cash Flow Quadrant? If you haven't read it, I highly recommend it. Okay? It's a big impact on my life. He actually doesn't like stocks. He doesn't like the stock market, but it's still very relevant to think of the E, the S, the B, and the I. The E stands for the employees, the S stands for the self-employed, the B stands for big business, and the I stands for investor. Okay? And in there, he describes the difference between each of these quadrants, both in activity and mindset. So a day trader calls themselves an investor, but if you subscribe to the Rich Dad's Cash Flow Quadrant point of view, a day trader is an S, and S stands for self-employed, which is also a form of slavery because you're constantly trading your time for money. Thank you, David. I highly recommend you go check out this book. I do have a referral link in the Discord group, but feel free to pick it up without the referral link. It's sold at tons of stores. Okay, so let's take a moment to get clear on the investing versus working. When we invest, we leverage our money to free up our time and make more money. It's very important, those 4 words, free up our time, free up our time. When we invest properly, we should have more time for life, more time to look at more deals, more time to focus on our health and ourself and go to the beach and our family. Investing should create time, okay, not take away too much of your time. The goal is to get out of the day job, to get out of trading, and get to the investing side of the quadrant so that you have more time to look at investing, but as well as more time to spend on the rest of your life and living life, the only life that you probably will get to live. Good morning, VW. Good morning, Gage. All right. When you day trade, you're committing full time to risking your own money to make more money, okay? Committing full time to risking your money. Okay, number 3, this is why day trading is just a risky day job and should be avoided. Okay, should be avoided. Number 4, day trading is simply worse than pursuing a high-paying job or starting a company. Why do I say that? Why do I say that? Okay, if you go pursue a high-paying job, they pay you to take on the risk. They pay you to do it. They train you to do it. If you start a company, you can make exponentially more money than day trading, okay? You can leverage. And number 5 ties in with it. If you're going to do that, if you're going to do either a high-paying job or start a company, you can risk someone else's money to get there. You get what I'm saying? When you start a business, you can sell shares, you can take on investors, you can get loans, okay? A lot of that's not really available for stock trading. You get a bit of leverage from your broker, but it's a little bit different, okay? But it's still your money. It's leveraging. They're giving you leverage for your own money. They're giving you margin against your own money. You're not taking in somebody else's money and then trading for it. Okay? That's why I consider day trading as a job, and I try to avoid it. And the wheel strategy is great because it's convenient. You can do it from anywhere in the world. You're not tied to a location. You're not tied to an office. Okay? It's low time commitment. You could do this 1 hour a day. You could even, I don't know if this is the right way to do it, but you could even get it down to 1 hour a week, just managing and picking your positions, okay? You could manage your positions for sure 1 hour a day, maybe 1 hour 3 times a day, and maybe even 1 hour a week, okay? I haven't done that. I'm much more involved because I'm actually trying to grow a business alongside this. Number 3, repeatable. It's very repeatable. Okay, there's a lot of businesses and a lot of investing where you're going out and you're finding these one-shots, these what I call one and done. I used to flip cars, by the way. Okay, and the problem with flipping cars is then after you sell a car and you make a profit, you have to do what? You have to go out and find another car. So then you have to advertise for buyers. You have to go look at more cars. Then you have to make a bunch of offers. Finally, you get the car. Well, now you got that car. You got to clean it up, fix it up. You got to repair it. And then you got to advertise it and talk to buyers and go on test drives, and then finally you sell it, right? So it's like 3 different full-time jobs wrapped up into one job. And every time you sell it, you have to go find another one. This is very, very repeatable. It's very repeatable. When you find a few stocks that you like, as long as they stay volatile, you can continue to use the wheel on them. You can continue to sell the options, okay? Number 4, compound growth. 2 to 5% a month will yield amazing compound growth returns as long as you're not taking all of the money out, okay? 5% compounded, just for quick math, 5% compounded. Let's say you take 5% and you get 5% returns over 12 years. 5 times 12 is 60, right? So 60% return? No. If you put all of the money back in and you compound it every single month and you happen to get that 5%, let's pretend you don't get any losses, okay? At the end of 12 months, you will compound to 8%, not 60%. That's an extra 20% in gains. You can also think of that as an extra 4 months return on your money. The compound growth in the wheel is very powerful. Number 5, downside protection. When you set it up properly, you should have 10 to 20% downside protection. This is why I like it better than day trading. It's why I like it better than buy and hold in many cases on many businesses, not always. Okay, but this is the strong, strong reason why this strategy is safer than buy and hold and why I love teaching it so, so much. Okay, when you understand the math, it is safer than buy and hold. Okay, Rashid asks, when you state repeatable, it will be interesting to know if you use a scanner to search for setups. Yes, I actually have my own scanner. It's called easyoptionscan.com. It's not available for the public yet. I am interested in making it available for the public. I don't know what to charge. There's other scanners that are free. There's BarChart, which is $20 a month. There is fees for running the scanner and improving the scanner, so I got to figure out how I'm going to make that available to the public. But I do have my own scanner. Okay. Number 6, safe. We limit our trades to good companies. We limit our trades to good companies. This is the opposite of intraday trading, or what you guys call day trading. Okay. When you're day trading, they just care about mostly good setups. It could be a bad company. It could be a good company. It could be Tesla. It could be a New Jersey deli. They don't care. They don't care. They're looking at the setups. They're putting in their stop losses. They're executing their trades. They're in and they're out the same day. There's no safety if they get into that trade and it drops suddenly and suddenly they own shares that they don't want. Okay? We're doing only companies that we like, that we know are good, that we've researched. Number 7, high probability. High probability. Doing it properly. Excuse me a second. Can you hear me? Okay. Okay. I don't know how well you guys can hear me or not. I'm just going to continue going, but please let me know in the chat room if it's cutting in and out, if there's any problems with the internet. I was seeing a loading wheel on the YouTube screen here. Okay, back to where I was. Please let me know in the chat room how the connection is standing up. If you set this up properly, you will see in the trading platforms that you're getting a 70% POP. But why do I write plus fundamentals? I don't because of the internet connection. I'm not going to wait for your answer. But the POP only deals with the option. Yep. Okay. Only deals with the price action of the options and the technicals. It only deals with the pricing. So you're getting a 70% probability of profit based on how that stock's options have been trading in the past. Okay. When you add good fundamental research to this, you should result in greater than 70% pop in reality, right? So the pop is in theory, okay, it's based on the numbers, and we can say it's in theory. If you do good fundamental research, you should get much higher actual probability of profit than 70%, but it depends on your research, okay? Personally, over the last year, anecdotally, I do need to go back and double check everything, but it feels like about 90% success rate. 90% of the covered short puts that I write do not even get assigned to me, and I think it might even be closer to 95. It also depends on some of the funny stuff I've done in the past. There's one month that's kind of bringing that down because I did a bunch of shotgun. I did like 30 trades instead of 5 trades, okay? Anyway, quick refresher. We probably should move this slide up to the beginning. What are options? An option is a two-sided contract between buyers and sellers that allows the buyer to trade 100 units of stock in the future at an agreed-upon price by a certain date. That agreed-upon price, by the way, is called the strike price. It is different than the price of the stock, okay? Stock price and strike price are different, okay? For this contract, the buyer must pay a premium to the option seller. So it's between a buyer who is a person and the seller who is a person, not the broker. The broker is the go-between. It's not between the buyer and the broker. The broker does not collect the money and keep it. The broker hands it off to the seller, which is us. It's us in this situation. So let's take an example. Virgin Galactic stock, $30. You could sell the May 7th $30 call a few weeks ago, for $3.50 a share. The buyer would pay $350 because it's 100 shares, so $3.50 per share, plus broker fees, roughly $1.25. Every broker is different. The seller would receive the $350 minus the broker fees, so about $348.75. So you can see the broker and CBOE is making about $250 between each other, just for putting the deal on. Okay? But the buyer and the seller are the ones trading money. They're the ones putting money. They're putting money into your pocket. Give me a second. So, when you do options, there's obviously puts and calls, but there's also buying and writing. Buying and writing, writing is also known as selling and shorting. It's all the same. Sell, short, write, all means the same. The other one is buying. When you're buying an option, you're buying a call because it creates leverage. It's pretty much the only reason to buy a call I can think of is you're creating leverage. Instead of tying up $100 times 100 shares, maybe you're tying up $10 times 100 shares. So So you're creating 10-to-1 leverage. That's why you buy a call. When you buy a put, you could either be shorting the stock, meaning you think, shorting it with leverage, meaning you think that it's going down in value, or, here's the other case, you could be buying insurance, you could be hedging, you could be hedging ownership in that own stock. Maybe you own hundreds of thousands of shares, and you want insurance in case it goes down for a bad event, or maybe you're doing a short-long position, so maybe you're buying Tesla and shorting NIO, or buying Tesla and shorting Nikola, so that if the whole sector goes down, you're balanced out. So you could buy a put for insurance. Now, buying options, high risk, uncapped return. Puts a little bit different, they are capped returns, but they're high risk. Why? Mostly because time is against you. It's very important to know. Time is against you when you're buying an option. If options were unlimited time, they would be the greatest thing ever, and no one would sell them because it would always come true eventually. Okay? So you must be right on time, so you must time it right. Yeah. So you must time it right or lose when you buy an option. Writing options carries very opposite situations to the buying options. When you write an option, it is a low-risk, medium-return strategy. Low-risk, medium return. Most of the time, depending on how you set it up. Okay. Number 2, you get monthly premium. Number 3, it lowers your cost basis, also known as downside protection. If the stock is currently trading at 30 and you collect $3.50 on strike price, okay, your dollar cost average is $3.50 less. You're almost 11%. Am I doing that? Yeah, almost 11%, 11.5% downside protection on that share. Excuse me. And most importantly, very, very important, time is on your side. Time is on your side, so you don't need a crystal ball. You don't need to know, is it going to go up, is it going to go down, and pick a direction when you use this strategy. By the way, the wheel strategy is actually what I call a tri-directional trade. You can make money when it goes up, you can make money when it goes sideways, and you can even make money when it goes down a little bit. So let's put all of this together. Let's put all this together now and describe mechanically the wheel. It's such a simple thing that if you're experienced in options, it's almost too simple and it's just unbearably simple to talk about and think about. But there's a lot of nuances and there's a lot of tips and tricks you can still do with it that you get through experience and through thinking through things. Now, if you're brand new to options, this is just confusing, not because of the mechanics, but because of the terminology. Because of the terminology, because of the mathematics, it becomes confusing. But this is honestly, it's the safest, best strategy that I could think to teach somebody new to options. So one of the worst things you can do if you're new to options is go out and start buying options because you don't understand how they're priced. You don't understand the impact of implied volatility and theta decay. I have been IV crushed before when I was buying puts during the March COVID process, during the March COVID crisis or whatever you want to call it, okay? I was buying puts, and even when the put went in my direction, in other words, the stock was going down, I still lost money because of what's called IV crush. IV crush. So, I want to put people on the right track. I want you guys to have high probability, low risk, medium return, and if you do the wheel, you will start to understand all of the other types of options, and you will understand how to buy options. This is, honestly, the best strategy that I could possibly think of to teach new people getting into options. So let's break it down. The first thing you do is you go and do the research to find a good company with a good setup. Once you have that, you write a cash-covered put. Writing means selling, so you're going to sell the cash-covered put. You click a few buttons, and then boom, that contract is created and somebody else buys it, okay? How do you know what price they buy it for? They're literally bidding on it. They literally have the price that they're sitting there, and you can see it in the platform. They want to buy it for $1.50, you can immediately sell it to them for $1.50. Let me know if this is all making sense so far. Okay? Once you write that cash-covered put, you're just going to wait. You're waiting for it to expire. You're waiting for time to be on your side. You're waiting. Remember, time is on your side, so you're just waiting for time to pass. Every day that passes, that contract loses value. And remember, you sold it first. So the best thing you can do is go to zero or buy it back for a penny. Those are the two best things that can happen, okay? So you want to wait for it to just expire. Now, how does it expire? if you sell, for example, the $26 put, as long as it stays on a $30 stock, you sell the $26 put. As long as it's 26, 27, 28, 29, 30, 31, and above, at the end of the contract, that contract is worthless because they won't get any money for exercising it. You have to pay money to exercise it, therefore they won't exercise it. It costs about $5, at least I think on Tastyworks, to exercise an option. Okay? So, are they going to pay $5 to lose money? No, they're not going to do that. So they're not going to assign it. So what happens? If it doesn't get assigned, it just disappears, and the money becomes unlocked in your portfolio. It becomes unlocked on your platform. And then you do what? You look to see if you can do the cash covered put on the same company again. Because I told you, this is so repeatable. If you can do the same company again, you do the same company again. If you want to go look for more companies, you look for more companies. But again, you just go 1, 2, 3, back to start. 1, 2, 3, back to start. Month after month, collecting premium. Now let's say it actually does go below the 26. Okay, you sold the $26 strike, you got a couple dollars in credit. But then it goes to 25, you might get assigned. You might now own the stock. That is not the end of the world. That's a good thing. Depends how low it goes before it becomes a bad thing. But if you sold 26, collected $2 in premium, and then got it to 25, well, guess what? Your cost basis is 24. I know I'm throwing a bunch of numbers fast at you, and when you're new, that's confusing as heck. So I'll do it again. Right? $30 stock. It was currently trading. You sold the $26 strike, and you collected $2 in premium. Your cost basis is really 24. So as long as it's above 26, you won't get assigned. I won't say that you can't get assigned, but it's not going to happen. When it goes between 24 and 26, you can get assigned, but you could immediately sell the stocks. You could immediately sell the stock and collect the difference. If your cost basis is 24, it's currently trading at 25, you got assigned at 26, but your cost basis is 24, you could sell the stock and keep the dollar difference. Okay? Or if it goes below 24, let's say it goes to 23, now you're a dollar negative. Remember, cost basis is 24. Cost basis, break even and cost basis, same thing, very important. Okay, more important than the strike. If it's below your cost basis, you now own the stock. You then sell, right, short, okay, same thing. You write the stock covered call using the stocks to take care of it, using the stocks to cover it. Okay, we're not doing any naked strategies. We're not doing anything that requires level 3. This is all level 2 stuff. This is all easy peasy, okay? And there's not unlimited losses. Our losses are fixed. You can only go to 0 on each stock. You don't have unlimited losses as if you were writing a naked call, Okay, we're writing, everything we're doing here is covered. Covered put and covered calls. I saw the 2 questions, I'll get to them in a second. Okay? Now, what do you want to do? You want to figure out your break even, and you want to sell a stock covered call at or above your break even and collect the premium. And if in 30 days it does not go high enough to get taken away from you, then you just repeat it. Then you sell a stock covered call again, and you wait for it to expire. Then you sell a covered call, wait for it to expire. Boom, boom, boom. Profit, profit, profit. Every month you do this, you're collecting profit, and or you can think about it as lowering your cost basis. Now, eventually, it might get an exercise. That means the stock gets taken away from you, and they're forced to buy it from you at the strike price that you sold the covered call on. Okay, what happens? Now you have cash again. What do you do with that cash? You write covered puts. This is why it's called the wheel, because it just repeats itself over and over. I'm going to get to the questions now. I'll go through them in order. Rashid Wahab asks, if you're making a few trades per week, and you wait 3 to 45 days to expiration, do you need to have funds locked with a broker for each trade? It could be expensive unless I'm mistaken somewhere. Every single trade that we're doing, when we're writing these, the broker will lock away what is the break-even price, the break-even. Yep, that's fine. Yep. So, again, let's use our example of the $26 put on a $30 stock, okay? If you got $2 in premium, the broker will tie up $24 times 100. Why 24? Because it's the strike minus the premium. So basically they're wrapping the premium into the money that they're holding. You're getting, because you get the money up front, okay? So yes, it is expensive, but it doesn't. You don't have to open trades every week like I do. Okay, you can open up trades once a month. There's a great platform, a great signal company called the Options Oracle. You can visit them at optionsoracle.com. They've been giving option signals since 2009, and they only do it once a month. So most of their subscribers only trade options once a month. They run the same strategy. Okay, Guy Rederis, sorry, Mr. Guy, for messing up your name. What happens in reality is that when your put expires in the money, the stock usually drops so much, then you can only sell the call that is a much lower price than your initial price. Well, Guy, I'm gonna say that can happen. But what did I say was our number one rule and number one thing to do? Do our fundamental research. You have to do your fundamental research. You have to pair good companies with good setups. Okay? Now, I'm going to tell you guys, since you asked the question, that even when that does happen, and it does happen maybe 10% of the times that I get assigned, okay, it does happen, what you can still do is, number one, is I would go back and I would re-research the company, and if it's a terrible company or if the company changed, I would honestly just dump it and move on. Let's be honest, okay? Number two, if it's still a good company and the price is just squashed for whatever reason, whether it's technical analysis, institutions, FUD, whatever, you want to reach up, figure out your break-even, and try to sell calls halfway to the break-even if you can, or higher, to earn premium, and then claw your way back up. And then you have to get good at what's called rolling. It's a bit more advanced than our topic for this 30-minute segment. We'll go over it. Is if you start selling the covered calls, yep, I agree, guys. Sometimes good companies drop for bad reasons. Okay, if you start selling the covered calls, then the price goes back up, and you risk losing the shares. You have to roll it forward. You have to roll it forward. Now, is this a perfect strategy? Does it work all the time? No. No, it doesn't work all the time. Okay, but you earn so much premium across different companies and different sectors that it makes more than makes up for it. I've taken personally over the last year a $25,000 account that only trades the wheel, and I've grown it to $43,000. So I disagree with your statement that says what happens in reality, only to the point that it only happens sometimes. And there's ways to work your way out of it. This is, again, I said before, it is a management strategy. The wheel is a management strategy. You have to learn how, it's basically prescribed already in it. The wheel isn't just sell cash covered puts, sell covered calls. The wheel is putting good companies together with good setups, selling the cash covered put, and then managing it correctly. That's the strategy of the wheel, is learning how to manage it correctly. Let's continue forward. I want to rush through this just to give everyone that's watching. Thank you guys for watching, by the way. I want to give you guys some Discord invites as soon as we get done going through the platform, because we got 13 viewers on here that might not know how to do this. If you use Tastyworks, this is what it looks like on finance.yahoo.com. We used Virgin Galactic 2 weeks ago. This is actually a good example of when a company drops. Okay? You could have sold the $27 strike for $1.65. If you're following along, you know that you take $1.65, subtract the 27, reverse that, 27, subtract $1.65, and you'll end up with a cost basis of about $25.35. Okay? Also known as your break even. So let's quickly compare this to the wheel versus buy and hold. And I do appreciate your comments, and I will continue to respond to them, guys. I just want to get through the rest of this for the new viewers, okay? So if you're doing buy and hold, and you bought the stock at $30 and it went up 10%, you'd make $300. Pretty easy. If it went sideways, you'd risk all that money and you'd make nothing. And if it went down 10%, you'd lose $300, etc., etc., etc. If, however, you sold the $26 put, Kiki, quiet, it's my dog. If you sold the $26 put for $1.30 in premium, your break even will be $24.70. I should put a zero there. Okay. If it went up 10%, it'd be above your break even, so it'd expire worthless, and you make $130. So you're making less than the guy that bought and hold, but you're getting much less risk. And let me explain how. Scenario B, we shouldn't use the word option here. Buy and hold guy did nothing with his money. You still made $130 because the option expired worthless. Scenario C, it goes down 10%. It's still above your break-even. 27 is above $26 foot. You collect the full $130. If it goes down 15% to 25.50, okay, it would be below your strike, but notice that it's above your break-even. So you still make 80 cents a share, so you still make $80. Okay? You'll probably get assigned the shares. You just turn around and sell the shares, collect your $80. It's all good. Okay? Scenario E, it goes down to $24. Mr. Buy and Hold lost $600. It's now 70 cents below our break-even, so we lose $70. Do you want to be the buy and hold guy that loses $600? Do you want to be the option seller that loses $70? It's your choice. Okay. Scenario F, it goes down 25%. Like we said, sometimes bad things happen to good companies. The stock's currently $22.50 a share. Mr. Buy and Hold loses $750 because it's obviously 25% down from 30. But for us, it's only $2.20 below our break-even. We're only losing $220. So do you want to be Mr. Buy and Hold, or do you want to be the guy selling options? It's your choice. Okay? Quick calculations, and we do need to rush through this because we're getting close to opening bell. All right. If we did the $26 put, and we got $1.30 in premium, and you want to figure out your ROI, doesn't matter how many days it is, take the premium divided by the strike price, so you get 5%. We did a 30-day option as the example, so that's 5% in 30 days. Now you want to know, 5% in 30 days, what type of APR is that, so that we can compare it. Maybe I should sell the 4% in 3 weeks, or maybe I should sell the 6% in 5 weeks. How do I know which one is better? You take 365 and you divide it by the duration. So here we're doing 30. 365 divided by 30. Then we multiply that result by the percentage that we're getting. And so you'll end up with about 6.1%. All right? Excuse me. Okay? And like I mentioned before, if you compound out 5% every single month, you'll end up with about an extra 20% at the end of the year. It scales up. It's not linear. It's more like super linear. So 5% will compound much faster than 1%. Okay? I typically don't find too many opportunities that are worth doing above 5%. I mostly stick to 4 and 5%. I want to give you guys a quick example using Tastyworks, and there is a referral link to Tastyworks down below in case you want to sign up after watching this. It is the broker that I use. I don't just give out the referral link because they pay the best. I don't think they even pay the best. I don't care. I use them. I like them. Here we did the space contract, SPCE. Here you see the bid price was $30.70. By the way, I did not make this trade because earnings come out May 4th, and also I dodged the Richard Branson bullet on this one. So this is what it'll look like if you type in space. It'll come up with all these different durations. So we're going to click on the May 7th, and you're going to see that it's 31 days to expiration. Right here is the 26 that we were looking at. The $1.30 was the last sold. $1.34 was last sold, which is what you saw in the Yahoo Finance. You'll see that the bid and the ask is between 99 cents and $1.51. So you can put in your bid. Sorry, you can put in your limit order anywhere between there and try to get filled. The closer you are to 99 cents, the more likely you'll get filled. In fact, if you put it at 99 cents, it should get filled right away most of the time. Okay. If you want to make a sale, you click on the bid. We'll change the price later, but you want to see this red bar, this red S1. Down here in the bottom left, you'll see POP, 75%. Means the probability of profit based just on the trading ranges of the options is 75%. Remember, this does not include your fundamental analysis. You'll hear other people talking about delta. Delta and POP are very similar. POP is a little bit more accurate, so I prefer to use POP, at least in my experience. Okay. Down here, you can set your limit price. You can type in whatever you want, $1.34, $1.30, whatever you want. You'll see that the max loss changes based on your limit price, and all it's doing is it's taking $1.34, subtracting 26 from subtracting $1.34 from 26, and then showing your max loss times 100 shares. So if you want to know your break even, it's right here. It shows your max loss, add the decimal points to it, and that's your break even. If you want to continue, you click review and send. If you want to understand the curve, you click curve. This shows the range for your profit and losses. As long as you stay above 26, you get maximum profit. Between 24.70 and 26, you get reduced profit but are still profitable. And below 24.70, you start to lose value. Okay? That's what it looks like. This is what it looks like if you click review and send. You can see here that it says -1. One space option -1. That's because we're selling it. STO, sale to open. Here you'll see it $1.34 or $134 in CR. That means credit. Money going into your account, not going out of your account. If you see debit, you're doing something very wrong. And if for some reason you put this order on and it has not gone through yet and you want to cancel it, just click that activity tab. Then right-click on the bar where it says space or pending, and then click cancel the order. If you want to change the order, you can replace it or click similar. I find a replace doesn't really work for me, so I usually do similar order. Okay. If I did a great job teaching you guys the wheel, if you like this channel and the free content that we give, I do encourage you guys to use our referral links and consider tipping. And I'm going to hand out now some Discord invites because you made it to the end of our little presentation here. Give me just a second to create the invite. And these invites are only available during the live stream and will only work for the next 30 minutes. So you must use it within 30 minutes. And I appreciate you guys watching this. And I'm happy to answer any more questions that you guys have. Yep, Guy says, yes, you roll until they correct back and break up through your call. Well, that's why you roll. Rashid says, I agree, the wheel strategy is good and downside can be protected with rolling forward as needed, but choosing companies you are happy to hold. And that's absolutely right. If you're happy to hold the company, then you can even just sell the covered puts, just take possession of the stocks and then just hold. You know, once you have possession of the stocks, the first thing I do is I go read through the news and I reevaluate the company, I reevaluate their fundamentals, and I decide whether or not it's still a good company. If it's a good company, and I can sell for premium close to my break-even, or hopefully above my break-even, then I always do that. I always sell to collect premium above my break-even. Okay? If I cannot reach my break-even, like Mr. Guy points out, then I will try to reach halfway. And then as it moves up, I will continue to roll up the option so that it doesn't take away the stock from me. If I cannot, if it's still so far away, but I believe it's a good company, then I'll simply hold the shares and I'll wait for the company to recover. But if I go and do the research and I make the new distinction that I'm now bearish on this company, that it is a trash company, well then trash belongs in the trash can, so I dump it and get rid of it. All right. Here we have my easy option scanner. We did a scan today, but I'll tell you, not going to be opening any positions on Riot or Mara, or not on those because they are Bitcoin related, and Bitcoin has had a crash over the weekend, down 15%. So these are most likely no longer valid numbers. We're going to see Riot and Mara correct in the pre-market. In fact, I believe they already have. Riot is down 7% in the pre-market, now trading at 35.88. So this would no longer be valid. Unfortunately, my scanner is not a live scanner. It scans after the market closes each day. Oh. Give me a second here. I just want to check our Discord channel. Hey, we got one more person to join. Welcome to the new Discord channel. All right, you guys this is where I open up the floor even more. If you guys have any questions related to the wheel, related to trading, position sizing, managing positions, anything like that, feel free to ask. And also, if you have any stocks that you want me to look at, it's a lot of fun for me to look at your stocks, look at your setup, see if there's an opportunity to run the wheel on it, and to quickly do a shallow dive on the fundamental analysis. I use a website called wallmine.com. It's the same information that you should get off of Yahoo Finance, but it is very, very convenient the way they have it set up. I'm going to take a look at Workhorse. I don't plan on trading Workhorse, but I want something to look at today. I already have some positions that will probably go through this morning. What is our price action going on Workhorse? Workhorse has gone very flat for the month of March, mid-March. And they did not get their USPS contract. Pins, Chester wants pins. Happy to take a look at that for you, Mr. Chester. Pins obviously is Pinterest. I want to come over here. First thing I want to do is I just want to get a sense of, since they've been out, what have they done? They opened at $17 or IPO'd around $17. They've continued to climb steadily on a solid uptrend. They've peaked at 87, they've peaked at 85, and they've had a bit of a pullback. Let's zoom into the month here. They've had a major, I'd say that's a pretty major correction from 85 to 75. April 16th, which is Friday. All right, so what am I going to do first? The first thing I want to do for my fundamental analysis, is I want to come out and I want to look at their income and see if this company is profitable. They are very profitable. So 2020 they were negative. 2018, 2019 negative. 2020 still negative. And now they've turned the corner in December, being $200 million positive. So they've gone from negative geared growth to finally turning a profit. Okay. What I want to do, I want to look at their cash on hand versus their income. Now that they're positive, this doesn't really matter so much. But if they were going to go negative, they usually lose between 95 and 140 million per quarter. So let's just say it's 125. Okay. And I want to take their cash on hand, 678, and I want to divide it by 125, what they're used to losing, and I get a math. I get a quick number that tells me that they would survive 5.5 quarters before they needed to raise capital. That is okay. I like to see 8, but anything above 4 is okay. Next thing I want to do, I'm going to take their assets to liabilities, and I can already see that they're very healthy, but let's just do the math. We're going to take 367. And we're going to divide it by 26. My computer's freezing. All right, I just clicked off it. 26. Come on. My calculator is freezing. Okay. 367 divided by 2609. And that'll tell us that they have 14% leverage on their balance sheet. So, what does that matter? I think it's very easy for them to go out and raise capital up to 50%. It gets harder and harder after 50%, and after 70%. It's very hard for them to borrow money from the banks, and so they will either be liquidating assets, or they will be creating new shares, or they will be facing problems. So I like to see anything above 7, below 70 is okay, below 50 is better, and when it's down here below 20, that's great. So their balance sheet is great, their income is great, their cash on hand is great. So those are all very green, positive things, and this is one of the things that I look for when doing the wheel, so that we don't have what happens to Guy a lot, I guess, is we don't have companies that just suddenly crash below 50% on our strike price. Another thing that you want to do is avoid, on with the wheel, in my opinion, is avoid meme stocks. So anything that's trending on Reddit and TikTok should probably have a second look at it. All right. The revenue quarter-over-quarter growth is 76%. That's insanely great. That's insanely high. That's fantastic. But that's also because they went from negative to positive. So it's almost irrelevant. I just sort of remembered that while I was talking about it. Institutional ownership is very high. Institutions spend a lot of time and money researching companies, so we can lean on their research and say, you know what, if the institutions like it so much, it's probably not too terrible of a company. Return on assets, return on equity, good to know, but these are all negatives. That's a negative sign, that's bad. But again, they went from growth company, they're going from negative geared to positive geared. All right. Next thing you might look at is some of your technical analysis. You saw here that they had a big dip, and the SMA crossed over. It looks like the SMA is catching back up to each other. Then we had a big dip again. Take from that what you will. I'm not too big on technical analysis. It's not as relevant for the wheel as it is for intraday trading. So, anyway, Chester. I think this is a good company. Now let's see if there's a good setup. So far it looks like a pretty good company. If you wanted to, you could spend all day doing deep dives on the fundamentals. The more you do of that, the more correct you'll be in your assumption of where it's going to go in the future, which then is basically adding to your pop. Remember, your probability of profit might have been 75%. If you were to do the fundamental analysis correctly, you could be increasing or decreasing that probability of profit based on what you come out of that with it. So let's go a month out. Today's the 19th, so let's say the May 21st. Throw that into a straddle. Let's see if we did at the money. We're not going to do at the money, but if we did at the money, I would like to see greater than 8%, 6.16 divided by 75, and we got just above that. We got 8.2%, which means that somewhere we can get 5% out of the money. So let's take $1.24 divided by 60. I don't know what that is. That is only 2%. 2.37 divided by 65. 3.5%. Not looking too great. 4 divided by 70. There's your greater than 5% you did at 70, but you're only getting $5. You're only one strike away. You're only getting $5 downside protection, but you are getting close to a 6% return. So between the two, I might reach down and do the 65 strike. You'll get a lower ROI, but you're gaining an extra $5 in distance in case the stock continues to drop some more. And if we go back and look at our chart here, let's pretend we did the 65 for 237. So our break even would be about 62.40. Round up. Let's just round it. Okay. The 62.60. If we look at 62.60, we'll notice that they have not touched 62.60 since November 10th, 2020. So that makes me feel like that would be very good. For those that like technical analysis, you'll see that your support levels are here at 64, 62. What is this, 62? So you're seeing a lot of support levels at 62. I like to look at the trading range. I see that we're at the bottom of the trading range. So that's where I'd like to set my strike, at the bottom of the trading range or below it. And if there was a recent trading range that was lower, I'd want to reach back even lower. But in order to get the 4 or 5% that we want on the stock, you want to open it up at about the 62. So there you go, Mr. Chester. How was that? Other thing you want to look at, though, earnings are on May 4th. Earnings are on May 4th, so that is coming up very soon. So that would be a good reason not to open this position on pins, because of the May 4th earnings. It's actually in a couple weeks. It's not at the end of the week, but you're right. In a couple weeks, unless this is wrong, unless you're saying that it's actually sooner. Oh, okay. See, Wallmine shows it as the 7th of May, but it is actually coming out April 26th. So I would not do pins. I would not do pins. Okay? If you think they're going to do, here's why. If you think they're going to do positive on the earnings, then maybe doing something else to get higher risk, higher reward is the way to go. There's not a whole lot of reason to take 4% gain and risk a bad earnings to come out. You're probably better off waiting until after earnings to make that trade. So I hope that helps you, Mr. Chester. Let me know, guys, in the chat room if you have any more stocks you guys want me to look at and research for you. Happy to do it. It's also good practice for those of you that don't do a lot of fundamental analysis, sort of a quick, dirty way. Yeah, well, their last earnings was good. Doesn't mean their next earnings is going to be good. I don't have any reason to believe that it should be bad. But also, not only does it depend on what the earnings are, but it actually depends on analyst expectations. So if analysts think they're going to grow 3% and they only grow 2%, even though they grew 2%, that's actually bad for the, that's actually bad for the company. Or it's bad for the stock price. So it's not actually bad for the company. Someone comes to take a peek at their news. Hey guys, if you guys have any stocks you want me to look at, let me know in the chat room. Otherwise, I'm just going to continue to check out Pinterest here. By the way, where are you guys? I'm in Bali. I'm in Bali, Indonesia. I've been here for a couple years. That's one of the reasons why I like the wheel strategy versus other strategies. And I'm not saying I hate day trading. I just think that if you're going to day trade, you can also go sell big ticket items, risk other people's money, and make similar amounts of money without risking your own money. But part of the reason I like the wheel trade is it only takes me an hour or two a day. And I put a bit more time into it because I want to build up a company around it. But if I really wanted to just can the company and do it as little as possible, I'd be happy with just 3 hours a week. So what does this guy say? Pinterest stock fell under pressure from a cautious note on March quarter financial results from Cleveland research analyst Chandler Converse. Converse declined to provide a copy of his note, citing a company policy to not share any of our published work. So, cautionary note, but he won't tell us why, basically. Quarter one looks like it ended softer than mid-quarter expectations would indicate. Deceleration from Q4. Mixed trends from larger retailers. So basically, it looks like Pinterest might be having a decline from big advertisers. Big companies, big advertisements might not be decreasing their Pinterest advertising, according to Mr. Chandler Converse. If we look at tip ranks, Chandler Converse, I don't use this site enough. I'm not always big on the analysts. I should check it out a little bit more though. He's ranked number 2,593 out of 7,459 with 3.1, 3.2-ish stars. 81% success rate. He currently says his pins is a recommended buy, according to 4 months ago. So tip ranks is not taking into account his recent change of opinion on Pinterest. Anybody use tip ranks a lot? I don't actually use this website a lot. Love to know if you guys like this website, if you love it, what you look at, what you don't look at. And again, guys, if you guys have any stocks and options or any trade ideas that you want me to look at, that's what I love about doing the live action. We've got 4 minutes to the bell. I'm happy to look at any of your ideas or answer any of your questions. I will be wrapping up at about 10 p.m., which is 10 a.m. your time, Eastern Standard Time. So we've got about 34 minutes together. And if you've enjoyed the show, if you enjoyed having my help in learning the wheel strategy and looking at your stocks, do consider tipping. But maybe more importantly is sharing this channel with your friends and family. Of course, hitting like, subscribe, the bell, and all those other silly things that we have to touch now just to get notifications of when our shows start and show up. But more importantly, share it with your friends and family. We want to teach people the wheel strategy. We want other people to learn how to trade so they don't have to work full-time at jobs that they hate, so that they can retire in Bali or Hawaii or Spain or Mexico or Cancun or wherever they want to go, and then they can devote themselves to higher and better purposes instead of being a cog in somebody else's wheel. We want to end wage slavery for our friends and our family. That's what this channel is about. I just want to see what ARKG is going on. Oh, ARKG is down 1%. Not terrible, but I do own some shares. I have an option on this going, and I don't mind if I own more shares of it or if I end up owning shares for it. Because I'm big on genomics. By the way, sectors. We've got some time to kill. We've got 3 minutes. I think the big sectors that I'm interested in, obviously tech, but tech is always a growth sector. It's like almost like what the word tech means. It almost means nothing. But out of tech, I like EV and AI. Those should be big over the next 5 to 10 years. I like cannabis, but they are in oversupply right now. Maybe, probably. What's the other things I like? I like genomics. Basically, I like everything that ARKG is working on. I like space, but are we too early? I mean, space mining is going to be massive someday. Virgin Galactic, I think Virgin Galactic, by the way, is just a stepping stone to, I think Richard Branson wants to mine asteroids. I think he's just using the repeatable flights in space for rich celebrities at $250,000 apiece to get his technology. It's like the stepping stone to then eventually be able to go mine an asteroid. And I think Jeff Bezos is doing the same thing. Elon actually wants to go to Mars and set up a colony. I think Jeff Bezos and Richard Branson just want to pull an asteroid towards the Earth, mine it in space, and then drop gold down. Gold and platinum and diamonds and all the other stuff. Asteroids are so full of rare minerals, it's crazy. Super valuable. Anyway, we've got 1 minute before the bell goes. Graphene, a new material, I mean, it sounds good. I remember hearing about graphene years and years ago. I have no idea when it's going to be viable. I have no idea when new materials like graphene and there's something else that was supposed to be carbon, like, right? Nanofiber carbon was supposed to be really big. They've been talking about new materials over 10 years ago. I have no idea when those things will actually matter. Sectors. I feel like I'm missing a sector. EV, maybe it's because I combined EV and AI. Electronic vehicles and AI. Cannabis, genomics, space. All of these are supposed to have rapid growth over the next 5 to 10 years. All right, the bell is open. Good luck, everybody. We'll take a look at my positions and see if there's anything I need to manage. Feel free to post comments and questions. And bear with me while I fix the password on Tastyworks. Okay. You'll notice I've got multiple accounts, and each account runs a different strategy. So, if we look at the wheel, I do see a sea of red this morning. Only Space and Kodak are up. I did have a position fill. All right. By the way, for those of you who are not used to David, I will take a look at VIAC in a second. I think we looked at that in a previous one. I'm not sure. All right, but for those of you who see this and suddenly get scared and all this, I've got a lot of positions on here. And one thing I'll tell you, though, is it's kind of interesting when you're doing options. The net liquid amount is not really your trade value. Like, how do I put this? If you have an option that's about to expire in a couple days, it might look like it's negative because its bid price is worse than your trade price. However, it's going to expire in a few days, and so that will trend towards zero. And this really shocked me and scared me sometimes, that I would see this net liquidity was just crazy, and then you just have to wait for it to expire and to play out. You know, like this one, for example, AI, and remember, you're doing trades on companies that you like. So AI is a company that I like. I think it might be undervalued compared to Palantir. So we put this trade on. It's come down since we made the trade. So even though my trade price, I sold the put for $4.40. So technically, if I were to close this now, I'd lose $1.60 per contract, times 2 contracts, okay? But we're still above the strike, much less our break even. Our break even, I just want to point this out for you guys, because this will scare you guys away if you don't understand it, okay? Our put is 65. We sold the contract for $4.40. Our break even is $60.60. So do I care too much that it's at $66? I still have $6 to go before I'm anywhere close to my break even. And I still have to drop another 10%. This is why it's so important to understand break even. Break even is the magic number, not the strike price. So David Hibson wants us to take a look at VIAC. All right. Viacom, CBS. Yeah, I'm pretty sure we looked at this before. Let's come 25 days out. do the math now. Is that 1%? Looks like there's a 1% at the money. Oh, but there's a crazy bid-ask spread. That bid-ask spread is almost useless. 32. Okay, this is better. This is more accurate. Take 2.3, divide it into 39. Okay, so here's the problem with VIAC. We're only getting 6% at the money, so it's going to be very hard to get 4 or 5% at the money at any reasonable price, at any reasonable distance. Looks like there's a good price right now on the 37.5, so let's take a look at that. You can still get 5% at 37.5. I think this is going to trend towards $1.50 if you don't open this soon. I'm not going to open it soon, so let's dive into, where'd my wall mine go? Lost my wall mine. There we go. Let's dive into some of the fundamentals for Mr. David. And David Hipson, thank you for being on the show today. Okay, come on, VIAC. Why are you not typing? Something's wrong. Is it my keyboard or is it the website? Something's wrong with the Wallmine website. It's not letting me type it in. Okay, something is wrong with Wallmine. It is not letting me type anything into its search bar here. I can copy paste though. Crazy stuff. Let's see if it loads. Alright, Viacom. Whoa, that's a big pullback. When was that? That was March 28th. Went from 99 down to 42. I can see why you're interested in this company. It's gone flat since 24th of March to April 19th. Sorry, 27th of March. Probably, if you sold puts here, by the way, David, if you sold puts here in the first week after March 26th, the IV would probably be crazy high and you'd get a ton of value. Whereas if we look at it now, IV is 66%, but I bet you if you went back there, it would probably be 130 to 200% IV. And if you really like the company, you probably could have made a ton of money on it. Institutional ownership is sky high. 91% institutional, 4% insider. Only 4% of this company is owned by the public. Quarter over quarter, whoa, that's why, huh? Revenue dropped 63%. Okay, return on equity is very good. All right, let's scroll down. They make 500 a quarter, 400 a quarter, 600 a quarter, 800 a quarter. But then it says that revenue quarter over quarter is down. So maybe this isn't putting in. I find that Wallmine needs to be a little bit better. Anyway, cash on hand. They're positive 8/10, so cash on hand doesn't really matter. But they got close to $3 billion in cash. They've got $52 billion in assets. Liabilities look a little bit high here. 36.6 divided by 52, not 62, not 26, come on. 36.6 divided by 52.6. Oh, see, there's a big red flag for me, Mr. David Hipson, is that, actually I want to, excuse me a second, I do want to check the price on Mara. I want to see what action is going with my Riot and my Mara. Okay, Riot is down $2, about 5%-ish, 3%. One thing I wish Tastyworks did is they showed the percentage on the movement. I wish they did that instead of just the change. Mara also down $3. Bitcoin dropped 15% because of a power outage in China, which lowered the hash rate, which spooked a bunch of people, which piled on FUD. All right, back to this one real quick. Mr. David Hipson, they have a ton of debt. Let's take a look at them in Yahoo just to see if earnings, when earnings. Dividends came out in March 11th. Next earnings are May 5th. That is coming up shortly. Okay. You know, my biggest concern right now is the debt. David Hitchens, I forget which institution, but they got margin called. Oh my gosh, yeah, what was that place called? Sounded like asbestos or something. Just like with Disca, same drop with both companies. Okay, so your thesis is that the price of this company dropped not because of anything they did, but because of that huge margin call of that company, whose name I also cannot seem to remember. Yeah, I feel like I was thinking the word asbestos. It was Archegos, however you pronounce that. So your idea is that because Archegos had that big pullback, that a lot of these mega institutionally owned companies are going to have a big pullback, as all these other companies tied to this scramble to fix their balance sheet, huh? That could be a very good thesis for getting into this company long term. I want to check. Let's do something that's besides a wheel. I want to work on this. Let's see if there's a Super Bowl pattern we can do on this. Yeah, that's a very good point. Maybe that's why the price was so inflated. You could be onto something there. Anyway, I'm going to take I'm feeling a bit tired. It is 9:40. I do like to set up my trades during the day rather than while it's live, but let's see if I can do something during the day, during live action hours. Okay. What if, instead of setting up the wheel, what if we wanted to do a Super Bowl? How did I do that? Was it AI? One of these companies I did a Super Bowl in the other account. Anyway. Not recommending this, I'm just taking a look at it. Let's say we bought, not sold, we bought one call at the money. Oh, what was our chart pattern here? Let's go back up to about the 60 maximum. What if we sold 355, we did 175? That's not much distance. Where can we get $1? We can get $1 out of the 44.5. Okay, so if we sold one at the 44.5, don't know why this one is still there. This one is 25 days. Okay. So if we bought a call at 39 and then we sold one at the 44.5, so we'd make money between 39 and 44.5. And then what if we also sold some puts against it to finance this, because we got $1.83 in credit. So now we need 2 of these. Here's our quantity. We end up with 7 cents credit. Let's move that down. We end up with 69 cents credit. And then we reach all the way down and we bought 2 of these. Oh, don't do that to me. Okay, do that. Okay, so now we end up with 67 cents credit. This is some advanced shit you guys are looking at. Be careful if you try and copy this. Okay? And then we open up the curve and the analysis. Really important when doing this trade. So this is what is called a ratio Super Bowl by some, a Siegel by others, and a messy thing by some people. Anyway, if you were to put on this trade, because in my opinion, there could be big upside in this company, so maybe a wheel is not the trade that you would want to do. You could set up this trade, and this is what would happen. As long as this company stays between 39 and 44.50, you will trend up in max profit until you get to 44.50, and your max profit would be $616. Doesn't sound very good. We'll play with the numbers in a second. I'm just explaining the chart. As long as the price stays above $36, you'll make $66. That's our credit. And if the price goes, did we do this wrong? Did I sell double? No, I did buy to open. Where is my buy to open on my puts? There's my buy to open on the puts. So if it goes down to $20, you hit your max loss. So you could lose $3,000. You could credit 65. and you can make up to 615. That's not very sexy. Let's see what happens if we slide with the numbers a bit. Try and get our max profit and our max loss to line up a little bit better. That might not be the right stock to do this one on. Not losing too much of our max profit going between these numbers, so we can move the put down. But we've gone into debit territory instead of credit territory. So I need the put to be at 37.50 to get our max loss to balance out, and we get the $34 in credit. So I'm not recommending this one, but I'm just showing you how this works if you guys are following. David, are you seeing this? Again, I'm not saying you should do this, but if you wanted to go and research this and play around with this, maybe you could get this to work the way you want it to work. Okay? If you set up this network of puts and calls, you can create a scenario where you're going to get credit until it goes down to the puts that you sold. Then you're going to lose money, but only down until the puts that you buy. So you can create a max loss, max profit scenario that you like. While at the same time earning a credit. It's hard on this one. It's really hard to earn that credit and have a good max loss, max profit. So I probably won't do that on this one. But you guys looked at what that kind of looks like. All right, we got 15 more minutes. Is there any more companies to take a look at? Don't think I ended up with a ratio Super Bowl on this stock that I really liked. It looked like the max loss was still double the max profit. Could have got $67 on the credit, but then it still needed to move up a lot to get to that max profit. So, something to keep an eye on when you switch from just being wheeling to just being really bullish on a position. Let's take a look at stocks and see if I need to manage anything. When I manage things, I always go by days to expiration first. You want to manage things that are nearest. Tilray, you are still well over $1 from my break even. We have 11 days. State of decay should work to my advantage. GRWG, you're pretty flat actually when I got in. Okay, probably don't need to do anything on you. Hillian, I never should have touched you. What do we got in Hillian? We've got open calls, 4 of them. 850, we're moving away from the calls. I actually want this to get called away from me. What it is. Okay, space. Richard Branson, you took my money. Richard Branson, by the way, I want to just get this out there, still owns 24%, 25%, I think it's 24% of Virgin Galactic. He did sell $150 million worth of shares. It sounds a lot, but he still owns a huge chunk of the company. But that was enough to send the stock spiraling down from 29 to 23. And a big reason of that is because he did it before earnings. If he had waited till earnings and then sold the stock, I don't think, well, maybe. Earnings are probably going to be pretty bad. I haven't put anyone in space yet. All right, Afria, you're merging with Tilray. Of course, you're just going to mimic Tilray. Oh, man, it'd be nice if I could close you early. But I'm not going to get 17 cents because your bid-ask spread is too crazy. But, you know, we can put that in there and hope it goes through. I haven't done it recently, but Chester asked, why would he do that to himself? Well, I mean, he bought it. He bought shares at $10 a piece, and then he sold them at $29. Can't blame him as a trader. All right, Kodak. Kodak was a wild play. I tried to get arbitrage play on Kodak. It shouldn't even be in this account, but it's the only account where I had enough funds available at the time. The rest of the funds were tied up. So Kodak was not supposed to be in the wheel account. And here it sits. Crazy bid-ask spread, can't do anything on that. That's moving against me a little bit, but we're still well above the break-even, so we don't care. Luzi's moving against me, but we're still $2, 10% away from the break-even, so we're fine. Notice, guys, I talk about break-even a lot. Break-even is way more important than strike price. ARC G, we sold the 83 for 2. You're at 88.26. I'm happy to own the shares. I will never ever manage you. I want the shares. Apps is doing good for us. Riot shares. For those of you watching, it shows a straight price of 70, but I sold the put for about $26 in premium, and I sold 9 other contracts at a lower strike price, which did expire. So these 100 shares are free. That is just free money sitting there waiting to go up and be collected. INO. That was the company that did not go my way. I should probably dump this company at some point. Alrighty. We've got just 10 minutes before I'm signing off. I do appreciate you guys watching. If there's any questions that you have, if there's any stocks that you want me to look at, if there's anything about managing your position or opening or finding stuff that you want to ask or talk about, feel free. Type it in the chat room. I like to make this as interactive as possible. And once again, I do want to encourage you, if you enjoy this channel, of course, yada yada, like, subscribe, yada yada, but more importantly, actually share it on social media with your friends and family. We need to drive more people to this channel. It takes a lot of my time and energy to run this. It is fun, but it does take time and energy to run this channel, and we want to make sure that it's a good use of the time and the channel stays alive. So if you share this with your friends and family, anyone that's interested in investing, any groups that you are investing groups with, let them know if we're doing a good job. Share it with them so that they can come and watch. And if you feel like it, or if you make money from this channel, do consider tipping in the tip jar. You can use PayPal, Bitcoin, Ethereum, Bitcoin Cash, whatever you're comfortable with, because I'm here to help you make money. I might not be the most exciting guy on the internet to listen to, but you know, this isn't about hyping a bunch of crap. This is about teaching you guys real strategies to make real money month after month. Again, I've taken a $25,000 account, which used only the wheel strategy, and I've grown it to $43,000. I'm not here to brag about my other accounts. I'm just telling you what you can do with the wheel strategy. A 70% growth in less than a year is no joke, no laughing matter. Happy to take a look at any more companies. If you have any ideas or even sectors, if we do a Google search, high growth sectors, 5 years. Let's see if we find anything. Let's see, over the next 5 years. That's just like occupations. I don't care about that. Growth sectors for investors to consider in 2021. Online retail, commodities, sustainability, emerging markets. Nah. Growing industries. Always looking for new trade ideas and new ways to find stuff. Renewable energy, cybersecurity. Cybersecurity. That is actually something to be looked into. I think tech is too much of a broad term. This is basically all tech: renewable energy, cybersecurity, biotech, virtual reality, artificial intelligence. Basically, just said tech 5 times. But cybersecurity is something that we should look at. Is there a cybersecurity ETF? Does such a thing exist? 7 cybersecurity ETF reports. Nice. There are some cybersecurity ETFs. Now, I like to use these ETFs to go inspect the sector, find out what stocks show up in multiple ETFs, and then consider my options on those. Oh, what is this? Not familiar with this site at all. All right, let's switch over to ETF database. The site's much easier to look at. ETFDB.com, one of the websites that I love looking at for trade ideas. All right, let's type in, what is it, CIBR, Cyber. We can click on holdings. Cisco, Accenture, Splunk, CrowdStrike, Zscaler, Fortinet, VMware, Leidos Holdings, Proofpoint, Academia, F5, Juniper. Okay, I've heard of Juniper and I've heard of Cisco, FireEye, Booz, and Checkpoint. Most of these I have not heard about, so that's cool. Close a few of these windows, make some room. Wall mine. Well, first, let's just jump into Tastyworks to make sure that these have options on them. And then find out what they're selling for at the money to see if we should do any research on them at all. There's no point in doing fundamental research if there's no value in the option. So, SPLK, nothing to look into. ACN, options are available, 480 to 285, that's a 0.1%. Let's do the math. That is a 1.7% at the money. That is garbage. Okay, let's do Cisco. I'm sure they're going to be too big for anything worthwhile. Oh, they're actually $1.40 at the 52. That's higher than I expected, but still only 2.5%. We've got 4 more minutes. Let me know if there's any questions that you guys have. I'm here for you guys. I can do all of this stuff during the day when I'm wide awake. I stay up late for you guys. That's what this channel is about. CRWD, CrowdStrike Holdings, 32 days out, 220, and earn 11. That is a 5% at the money. Better than what we've seen so far. Still not worth our time. ZS. Zscaler, 32 days out, 48%. IV, $8 at the $8.40 at the 192.50. That's going to be just 4.5% at the money. FTNT. $0.80. Ooh, 80 cents at the 180. Got a wide bid ask. You can say it's $1.60 at the 180. Still less than 1%. Doesn't matter. VMW. $4. Call it $4 at the 165. It's going to be like what? 2%. 2.5%. LDOS. LDOS. We're getting, well, at least the math is easy. $3 at the 100, so that's 3% at the money. Not worth our time. See, this is the fun, boring part of the wheel when you're going to look for new sectors and new ideas if they're not showing up on your scanner. PFPT, that sounds familiar. Oh, because we just did it. AKAM. Actually, this one might be okay. Oh no, it's at the money. Yeah, 3.5% at the money, not okay. SFIV. No, 3.5% at the money. BAH. $0.95 at the money. Nothing. CHKP. $1.70 at the money. That's nothing. $1.15. That's 1.5%. So we took a look at CIBR, ETF, cybersecurity. Cybersecurity is an interesting niche of tech. A lot of big companies are going to need it, are going to continue to need it. They should have a lot of sticking power once they sign up for a cybersecurity company. They're not going to want to migrate to something else. But I did not see anything super exciting for the wheel because the ROI at the money renders it useless. All right, guys. It is now 10 o'clock at night. I thank you for being subscribed and watching foxwithstocks.com. If you make money with this, consider using the tip jar. But please, please, please share this with your friends and family. Get them interested in investing and teach them a good strategy for beginners, for learners. Safer than buy and hold, and it's easier to learn than the rest of the options. And once they start learning this, they can learn the rest. Thank you guys, and have a great night.